The Fed's set to kick off its two-day policy meeting. You haven't been paying attention because it is. And as a result, Stephen Miran here, he's a former Fed governor, currently senior strategist at Hudson Bay Capital, also former Council of Economic Advisors chair. So you know a lot of the thinking of President Trump on a lot of different matters. I hesitate to lead a segment with money supply because it's so arcane. We just want to talk about what Warsh is going to do, Warsh and Company will do tomorrow. But I think it's important because it might inform us on what to do. And in the old days, all market players watched the money supply and aggregate money growth. In your work, which you're bringing back, I think because Warsh pays attention to it, we're at neutral right now.
Yeah, I think that's the takeaway from our work. So first of all, thanks for having me. It's been very clear from Chairman Warsh's statements and writings over the course of decades that he cares about the money supply. And so what I did with my colleagues at Hudson Bay, Nouriel Roubini and also Peter Ireland, a professor at Boston College, we delved into the literature on this to look at the state of the academic field on it. And money supply and monetarism more broadly used to be super influential in the setting of monetary policy. As you said, everyone looked at it every week, right?
Every week.
And then after a few bad predictions, monetarism really lost a lot of its shine, and then eventually became disused, and people stopped looking at the money supply, and the Fed stopped monitoring it. What we find in the paper, as we surveyed the literature, is that a lot of the reason why people stopped paying attention to money supply is because they just weren't measuring it correctly. As financial innovation occurs, as new types of money become invented, some of those types of money are more for store of value than for transactions. And so if your goal is to predict transactions, the economy, and money supply is growing for store of value purposes, like a money market fund, you're going to make bad predictions. Right? So what some of the modern literature that's developed over the last 10, 12 years has done has been to try to measure money supply better by looking at different types of money and how transactions focused they are versus how store of value focused they are. And when you try and weight them like that, in the same way, when you look at inflation, you weight shelter, you weight housing more highly than you weight video games because people spend more money on housing than they do on video games. When you weight money supply based on how transactions focused a type of money is, you get much, much better predictions. And that addresses a lot of the problems that money supply has had for usability in monetary policy. When you do it this way, you correctly capture the deflationary pressure after the global financial crisis, which is something that if you remember the endless op-eds and columns that M2 was exploding because of QE, there was going to be hyperinflation. That didn't pan out, and we still had sustained deflation, right?
Right.
You measure money correctly, you get that right,
and then
wrong.
After the pandemic, you can totally see what happened.
Absolutely. After the pandemic, even the most cursory look at money would have told you, hey, this inflation is going to be big. It's going to be persistent. You better get ahead of it and do something.
There's so many more forms of money to be used as transaction than there used to be even in 2008. You think about new forms now. How do you keep measuring those things? What did you have to do to feel like you really had your hands around it?
Yeah, so fortunately, we didn't actually do the measurement ourselves because there's other researchers out there, other academics who do the measurements. We use there's a Center for Financial Stability, which does a lot of the measuring of these things, and we use their data that they generously make available. But we reported on the studies, and we modernized and updated the studies for today's data. And as Joe said before, what we find when we do this is right now, monetary policy.
It's not like post-pandemic.
It's not
at all.
It's not like it at all. Right now, through this lens, monetary policy looks pretty neutral, which tells you that to the extent that we've had higher inflation readings in the last 6-9 months. It might be persistent. It might be temporary. Actually transitory this time. It's much more likely to be transitory. It's much more likely to be temporary this time because it's not driven by policy. It's not driven by monetary policy. It's not driven by fiscal policy. And so as a result of that, because that would show up in money also, right? The money supply doesn't care what the origin of the money is, whether the money originates at the Fed or originates from Treasury or internationally, right? If it were policy driven, it would be showing up in the money supply, and that's not happening. And so this is telling you higher inflation right now is much more likely to be transitory than it was after the pandemic. And
after the pandemic, when you looked at it at these, it showed that there really was a serious increase, and we should have noticed that it was not going to be transitory.
Absolutely. These would have been, 5-alarm fires.
And people that say that all it was supply chain disruptions that no one could have controlled that caused the inflation, this puts that notion to rest, does it not?
I think that this type of analysis is heavily indicative that the supply chain analysis was not the major driver of the inflation that we had, or even if you really think that the supply chain problems we had were a major driver, that they were the type of driver that monetary policy had a responsibility to counteract.
I see. So either way, there were mistakes at the Fed. So then did the case you just make us think that the Fed stays on hold tomorrow? Then?
Well, so that's my read, is that the Fed should stay on hold based on this, but also based on everything else that's going on in the economy. I mean, look at it this way. In June, you had a unanimous vote to hold rates constant. Since June, the inflation data have been very favorable, right? We had a marginally negative core CPI month-on-month print. So I don't know what type of reaction function would say, in June, I thought it was appropriate to hold rates steady, but then I had a negative core CPI print, and that's what pushed me over the edge to think I have to hike. Right? I have a hard time imagining what type of reaction function would say core CPI being negative is what pushed me over the edge to hike.
Okay, how about the argument that people come up with that for 5 years the Fed has been above its anticipated range of inflation? How and when do you have to deal with that?
So credibility is important, but the way that credibility manifests in monetary policy is through inflation expectations. And if inflation expectations started peaking upwards beyond the 1-year horizon, i.e. beyond anything transitory, that's when you have to really get concerned. And if inflation expectations beyond the 1-year horizon in the forward space started moving up, even I, as one of the most dovish people from the Fed, would get absolutely hawkish and say this is the time to tighten. And indeed, when I thought the tightening was appropriate after the pandemic, it was in part because inflation expectations were moving higher. So credibility is not really endangered until you start to see inflation expectations slip, and they've been very well behaved lately.
How can Warsh get to 2% without hiking rates? Is there anything in monetary theory that would allow him to do that? That's what we're trying to figure out. Short of slowing down the economy, it'd be nice to let the economy run hot and still be able to cut rates. But we think that's the only tool that the Fed has to keep inflation at bay. Is there a way to do it with monetary supply, with money supply?
Well, so money supply would tell you that policy is about neutral right now, right? If you wanted policy to be restrictive, you would want to sort of curtail that money supply. However, the question that you're asking is, should monetary policy be restrictive? And to me, the answer to that is no. In part because I view the elevated inflation prints as likely to pass out of the data. So when inflation's running high or low, you need to ask yourself why. And right now, we have a situation in which the CPI-PCE relationship is heavily distorted. Normally, CPI, the Consumer Price Index, runs about 30 to 40 basis points above the PCE price index, which is what the Fed formally targets. The reason CPI is biased upward is because of differences in the weighting methods. But right now, that relationship is inverted by about a full percentage point. So you have to ask yourself what's driving that. Because if you just looked at core CPI, you'd feel much more comfortable. So you'd have to ask yourself, I think, what's going on with PCE inflation that's moving it so much higher? To me, the answer is in large part measurement error. You've got these things like portfolio management prices that are causing 40 basis points of upward bias to PCE, helping to explain that one line alone explains 40% of the gap. And it's all measurement error. Portfolio management prices have been in deflation for decades. Every year there's a new article, ETF investors, fees go from 5 basis points to 4 basis points. That's 20% deflation, right? Instead, we've got a 40 basis point contribution. There's also noise in the software component. So the question is, why is the PCE-CPI relationship so disjointed? You need to ask yourself, is that actual inflation or is it a statistical aberration? To me, most of that inversion is just statistical noise. And that, to me, doesn't justify moving policy into restrictive territory.
I wish we could talk tariffs, because a month ago you wrote something. But we don't have time. You got to come back and talk, because you say zero tariffs probably isn't the best case scenario. Historically, a low amount, or at least some monitoring what other countries are doing to us is something we need to do and can actually help the tax situation, right?
Absolutely. Look, the economic costs of any type of tax increase a lot the higher you boost the tax. Now, with tariffs, the actual economic benefits start to be positive up to a certain amount if you're starting from zero. And that's because some of the costs of a tariff are borne by foreigners.